Hello, my name is GrizelvaGarcia, and with this presentation, I will be analyzing the risk and return with Peachtree Securities. Peachtree Securities is looking at the utilities industry historical trend. The different investments considered in this case are TECO, which is the holding company for Tampa Electric, Gold Hill, which is a domestic gold mining company, S&P 500, a mutual fund investing in the S&P 500 index stock composition, and the T-bond, which is a government-issued security. Utilities industry is facing challenges of cogeneration, diversification, deregulation, and nuclear generation. The T-bond is independent of the state of the economy because it is risk-free. This means it has no default risk because the issuer, which is the government, can print more money to pay the bondholder if needed. There was given data and several calculations were done to get the mean of the expected return. By multiplying the probability by the estimated totals in each state of the economy, the following results were attained. For the T-bond, there's a mean of 8%, TECO has a mean of 13.5%, Gold Hill has a 8.8% mean, and S&P 500 has a mean of 15%. This means that the S&P 500 has the best expected rate of return. This chart shows the standard deviations and coefficient of variations that were calculated. The T-bond with no risk has no standard deviation and no coefficient of variation. TECO has a standard deviation of 11.72% and a coefficient of variation of 0.87. Gold Hill a standard deviation of 9.12% and coefficient of variation of 1.03. The S&P 500 has 16.43% for standard deviation and a coefficient of variation of 1.10. In this slide, we see different investment portfolios that were calculated with TECO and Gold Hill. For the first one, we see a portfolio made up of 50% TECO and 50% Gold Hill, which results in a standard deviation of 8.13% and a coefficient of variation of 0.73. With 25% TECO and 75% Gold Hill, the standard deviation would be 7.83% and the coefficient of variation would be 0.79. With a portfolio of 75% TECO and 25% Gold Hill would be a standard deviation of 11.15% and a coefficient of variation of 0.9. The best one is the 50% TECO and 50% Gold Hill because it has the lowest standard of deviation. Now we analyze a portfolio with 50% TECO and 50% S&P 500. The result is a standard deviation of 20.02% and a coefficient of variation of 1.41. Now we are discussing the results of a portfolio with randomly selected stock. It depends on the market and the luck whether the portfolio will do good or bad. Investors can do research and based on what they find they might be able to forecast the market, but it is not guaranteed that they will beat the market. By having a portfolio, the investor can have more stocks and reduce risk. Also, the return depends on the type of investment. Most of the times in a single investment, one can either expect a return or a loss. There is no diversification that can offset a loss from another investment if the company holds a single stock. This graph shows the slope coefficients. The slope of coefficient for Gold Hill is y equals negative 0.3867x plus 0.152, and the slope coefficient for the T-bond is y equals 0.08. Therefore, the beta is 0.08, just like that of the market. At the beta of 0, the required rate of return is 8%, while beta of 0.6 results in a required rate of 12.2%. The beta at 1, meaning the stock's price moves alongside the market, results in 15% required return like the market. As seen in the graph above, TICO's expected rate of return is 13.5, which is above the required rate of return, therefore making it a good investment. Using the formula on the slide, the following calculations were conducted. If inflation expectations increased by 3 percent points, TICO's required rate of return would be 12.5%. When risk-free rate is 8%, the required rate is 11.3%. And now with the original conditions of 8% risk-free rate and 7% risk market premium, the required rate of return would be 15%. Decreasing the long-term debt ratio decreases riskiness, which decreases required rate of return. Thank you.